All right, great rotation seemed to be the buzzword of the day. So we're going to break down today's performance and the grinding trend that we're on, and what we'd expect to see in terms of who's outperforming who, and are small caps going to lead us on a are they going to become the new leaders as we have this bullish posture going forward from here, or like last time, is it kind of signaling that we are closer to a 23% retracement than closer than we were before? And the next 23% retracement, is that going to be the one that starts the intermediate pullback or not? So we're going to break that down in today's video. We're going to talk about the rally we're getting, and the strength of the rally, and the where who's participating and who's not. And we're going to take a look at a trade in one of those catch-up type companies, dead weights, underperformers, and see if we might find some opportunity there for a pretty decent directional trade over the next few months. So let's go ahead and get started. Today is Monday, August the 10th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see we continue, like that intermediate line's even higher now than it was on Friday. So up to 99.5. Really pushing higher. The near-term line staying up there. We're not really going, like you can see the ranges continue to be small, volume small. That's just very typical of mature runs, but we are moving this up. Look, the 23% line is getting very close to this up to the 78% level. The 38% line coming up to the 62. So we talked before how retracement down to the 38 might peter out at the 62 line, because there's typically some pretty volume there, pretty decent volume there, as well as a support from that Fibonacci retracement. But now you'll have both of them there around 29.40, depending upon how much further we lift that line up over to the right. So that's a pretty, there's going to be some pretty decent support there. And you can see, though, again, the problem with this rally is as much as we keep moving it higher, the intermediate line's also just going up just as fast. And so, if we can kind of blow up here to the upside, kind of a la January 2018, then we can really pull this 23% retracement up to the 30-day moving average and be fine. Kind of, we might get a move like that, right? Like where we just come down to the moving average and we continue to ride the trend. But if we pull back to the 23% line, because that's what that was a 23% move here. If we pull to the 23% line and break the moving average by that much, it's one thing to break it by a little bit here or a little bit there. But if we break it by that much to get to the 23% retracement level, then that's intermediate pullback, right? That's and probably won't stop there, right? And it might do that like right at the very beginning. Like here, it only took a few days and we got there. It might take only a few days to get there too, but then it might take a few weeks and hang around there, and maybe a little bit below it down to this 29.42 area, depending upon where the 38% line ends up by the time all is said and done. I mean, you look at like the Dow Jones, you can see it's breaking out to new highs here, and really turning up to the upside. And the Russell 2000 continuing its own little breakout of its 78%. It's kind of breaking out above the 78% retracement level that we got here. And same thing on the Dow, it's 78% retracement. Of course, the NASDAQ way higher, and actually losing ground here the last couple of days, while the Dow and the Russell have been breaking out. So, again, kind of shows, I don't necessarily think there's any kind of major long-term rotation going on. It just shows that, in the short term, there definitely could be some rotation, as the NASDAQ is just too overbought, and these haven't, these just catch up, right? They've been lagging for so long. I mean, shoot, they're just barely breaking the 78% retracement level. The NASDAQ broke the 78% retracement of that decline way back here in early May, like 3 months ago. It broke its 78% and kind of flirted around and finally got above it again. So, the Russell's 3 months behind the NASDAQ. And if you look at the S&P 500, it broke its 78% retracement level and stayed above it here in July. So it did it a month ago, over a month ago. So, you know, these other indexes are finally just catching up. See, the Dow did break above it initially there with the S&P, but then the S&P broke above it here in July, and the Dow didn't. It stayed below it until just now. The Russell 2000, you can see it got to the 78% retracement on the on that last move. You know, so they all kind of got there. The S&P, the Dow, the Russell, and then they all pulled back. But the S&P got it back above it here in July, early July. It got above the 78, and the Russell was way behind, still lagging behind, and finally breaking out. So just catching up. And remember, the NASDAQ is well above the 100% line of this pre-COVID high. The S&P is just getting to it, and you know there's some catch-up. So you know, again, same thing happened right here. If you recall when we talked about this before, that was just a catch-up move. It was a rotation. The Russell really outperformed the NASDAQ during this rally, but it was just a catch-up move because it had been lagging so much that it made a big push just to catch up to where everything else was. And I think that's what we're seeing right now. You're seeing a little bit of a catch-up move while the NASDAQ itself just kind of peters out and slows down a little bit. It might have a little bit of a bullish move too, but you know, again, it's already made the move that the others are just, you know, again, I mean, we broke the 100% level and then stayed above it back in June, so almost 2 months ago, and the S&P is just barely getting to its 100% line, and the other two are just barely clearing the 78% level, so they still got some room to run. So, you know, don't be surprised if we don't get a little bit of a catch-up, and the near-term line's down. We'll see how long it stays down, how far it goes down. Right now, that would be a bullish near-term low, and you would expect us to bounce here because of the bullish intermediate posture. Whether we do or not, it's another story, but you would expect the near-term line to bounce because of the intermediate posture and will continue higher. The S&P, and the other reason too is because all the other near-term lines are all entrenched in the upper reversal zone, not showing any weakness at all. So again, you know, it might lag, the NASDAQ might lag, but you would expect that near-term line to bounce back up here. Okay, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below our video here. If you're watching us on YouTube, that notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again tomorrow. It's a quick way to let us know that. If you like our videos and you want to let us know, you can do it with one click. You can do it right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Two, while you're down there, comment. What questions or comments do you have about anything I talked about today? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos at DavidSettle42 is my handle there. And then join our Market Outlook Facebook group that we've created. Of course, if you're watching us here on our blog, check out some of these other things here on the side, our Market Outlook live video, as well as our classes coming up. All of our subscribers, our monthly and our premium subscribers, get access to those. Our premium subscribers, of course, get access to other tools and resources, as well as our community, our class forums, where all of our custom content is. But at least our monthly subscribers get access to these two things here on the right. Also, click this heart. That opens up a new window. Hit that like button right there. Also, hit this thumbs up icon. It opens up a new window, a new tab as well. Hit that like button right there. Again, the more you do those things, it benefits us because Twitter and Facebook will promote content that has a lot of likes and engagements to all of our followers, even if they're not on when we post these. But it also benefits you because they will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, so back to the charts here. And again, so far, we're only a day into this week, but very good bullish candle here on the S&P 500, as well as on the Dow. I mean, look at the Dow closing above all these highs. Very, very bullish candle on the weekly Heikin-Ashi there. A little bit of an inside candle so far on the NASDAQ. That's not a transition candle per se, but it does reflect some weakening, obviously. And then look at the Russell. The Russell, big time Heikin-Ashi candle. So, you know, again, there's a catch-up. I wouldn't say rotation, but a catch-up trade going on in both the Dow and the Russell, and we're seeing that reflected in this long-term charts, while the long-term chart for the Nasdaq shows a slowdown. So a catch-down trade, so to speak, but still very, very strong positive momentum on a long-term basis. Again, it's kind of hard to fall off a cliff from long-term momentum, but it doesn't mean that we can't slow down from such high levels. 3 green arrows in the S&P 500. We're still trading above, not this chart yet. We're still trading above the 8-day moving average. The 8-day moving average still above the 17-day. The MACD and stochastics both still above their moving averages. Not necessarily the case, though, on the Qs. The Qs, we are flirting with, it's 2-day weakness basically got us down to the 8-day moving average. But we're flirting with closing below. We did actually trade below it on an intraday basis. The MACD and stochastics were also flirting with their moving averages. You can see the histograms turning over on the MACD for the NASDAQ. The Russell is gaining momentum here. So again, very strong momentum. Buyers are in control, 96th percentile on the stochastics. We'll continue to watch this. So you can see we saw the last catch-up trade, how strong the momentum got, and we'll see if we get that type of move again here. All right, let's take a look at the intraday chart now, and you can see the new 4-week high, the 4-week low is way over on the left. It's going to move up a little bit to right about this 319 area. You've got lots of touches around here, so it's going to stick around in that spot all the way until this low point gets off. So that's going to be a good sign for the low point, and the high point still on the right, so very, very positive. You can see, again, we've got gaps to fill, and these are all kind of regular gaps here, so we'll see if we end up coming down to the value area. We're trading well above the value area on the 4-week chart, which is pretty rare on a 4-week chart to be that above. You can see we were above it here in the NASDAQ. We've been coming down back towards it. We'll see if the S&P ends up doing something similar in that regard. Take a look at the volume. Again, way below the average, and the average is way down to 58 million shares, 66 million shares, excuse me. The trading range today at 2.8 points, again below 1%. So the more the more our ranges stay below the 1% mark, the more the ATR falls to and potentially through 1%. Getting through 1% is a big deal for a trend. The question is, are we going to get through it on the first drop to it? But are we going to use it for support on the way back, bounce back up? You can see the average volume is back to pre-COVID levels. So we're trading at 60 million. That's where it was over here. And then of course, during this nice, good, slow, bullish rally, we were at about 50 million. So it kind of gives you an idea of where that can go. So it's interesting to see the volumes back to levels that we were pre-COVID. The ATR is about a point higher than we were pre-COVID. We were below 1%, and now we're still up above it. And then looking at the VIX and look at that, just extreme lows in the VIX. Multiple days now below 80%. Very, 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 even without a drop below 20, which to me is the fascinating element that, that volatility has dropped so extremely low, and we've stayed above this really important mark, this 20 mark. So again, if we get a pop in volatility, the nice thing about being so low is it's unlikely going to pop up to significant levels, right? We're not going to pop up, to 115% again. We would have to worry about a market sentiment pullback. Or we're not going to pop up to 125%. We'd have to worry about a death cross reoccurring. But getting up to like 105% now, 105%, now we're looking at an intermediate pullback, and and it's unlikely we even get that high on the initial drop to the downside, if and when we get one of those. So of course, obviously we always get retracements, so we will at some point. The question is what it will look like and when, and how long it will take before we get it. Right? But the volatility is suggesting that we're just going to keep grinding until there's a catalyst that will spark that jump in volatility. Look for very small moves on very light volume with very small ranges and low volatility, and just grinding moves higher as we persist with a strong, about as strong an intermediate posture as you could possibly have, along with a really strong near-term sentiment that we haven't had this entire rally. I mean, look how high we are and how long we've stayed this high. That hasn't been replicated this entire time. So very, very strong moves. And as again, what's really driving a lot of this is that catch-up trade that we're seeing in these areas that haven't participated to the same extent, especially coming off of the pullback, the 23% retracement we got, which again is not a pullback, but a 23% retracement that we got coming off that June 8th peak. All right, so just to summarize our technical outlook, don't get too wrapped up in the great rotation. That's something you've been seeing on TV and some people have been talking about. There's been a strong outperformance on these large cap tech names. You would expect that they'll continue to be the leadership going forward, but they're not going to be the leadership every day and every week. There's going to be bouts of catch up that will be mislabeled as the great rotation. But the reality is, if and when there is a great rotation from large cap tech to other areas and now they start to significantly outperform tech, then usually that occurs in bear markets. When tech has really outperformed and led us up, and then everything starts to catch up. That usually happens because these tech names that are overvalued are coming back down to earth, right? And the pulling forward of a lot of these, this COVID-related pulling forward in this tech space is done. There's no more need for pulling forward, and so they come back to earth because there's no capital spending and buying going forward because it's all been pulled forward now. So they start to underperform, and that drags everything down. Just not as much, but that's how the 2000 bear market started, and we've seen a very similar phenomenon now going as we did in the late 90s. The question is how much longer it will last. I don't think we're looking for a pullback or bear market to occur by the end of the year, or even potentially even next year. As long as we're still on this bullish trend, you might see commodities take some control as they usually do at the end of long-term bull markets, as the dollar ends up weakening and inflation levels rise. But until then, just look for any outperformance in small caps or dead weights as just exhaled. I mean, this is the exhales that you see before the leadership resumes its leadership role. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree, as to why. What are you seeing that makes you a lot more bullish than what we're seeing here on our charts, or what makes you think that maybe we could start the bear market a lot sooner and get a lot more bearish here on a pullback. So let me know what you're seeing that drives that opinion down in the comment section. All right, now let's transition into what's driving this market here. And let's take a look at the different asset classes and how they perform. Again, you can see the Q's outperformance and small caps catching up with emerging markets and gold and commodities. I mean, that's about as weak dollar of a trade as you could possibly get with emerging markets and gold and commodities up there. And of course, you can see how bearish the dollar has been. But that's been waning a little bit. Now, let's just look at just today here before we look at the dollars chart. So far this week, you can see small caps started the day strong, but they finished kind of where they started. Commodities as well. Gold, QQQ really had a kind of a sell-off here early in the morning, and then they came well off their lows. So the QQQs actually outperformed from the low of the day going forward. Some pretty significant moves to the downside. Of course, the biggest driver of a lot of this bullishness here lately has been the U.S. dollar, and right now we're in the midst of a 23% retracement. Whether it turns into more than that or not remains to be seen. But you've got extremely oversold short-term sentiment with the momentum line down to extreme lows, the near-term line dipping into the reversal zone. So now the question is this enough of a retracement before we bounce back up? I don't think so. I think usually you'll pull back to the 23% line within the next few days. We'll kind of keep an eye on that. But I don't think the dollar trend is changing. And that's the biggest move that we have going on right now is this dollar. And that's from a long-term perspective, as we've talked about before. I mean, it's pretty overbought right now in the short term. but again, we can come down and fill in some of these levels here. If I were to come and let me edit this and change the color to a different color. Whoops, sorry. There we go. So if we can come down, I mean, look, you can see we didn't quite get through the 62% retracement of the decline, of the dollar's decline. We got up to the top. Now we've pulling back down. As of right now, we're pulling back down. The question is, are we going to come back into that lower half? You know, if we do, that means we're coming through the 23% retracement. Of course, the 50% line of this rally lines up with the bottom of the retracement zone. So I think that's our worst case scenario as we fall back to 114. And again, that would probably occur with more of an intermediate pullback as a whole on the S&P, getting the intermediate line to come down, which would actually be a very, very good thing. As of right now, again, you can see this chart is showing us a bullish bounce signal on the market forecast. The issue is, again, how far up above this. And as you can see, we can be pretty far up above the 30-week moving average. But the further away you get, you know, it's easier just to come back down. Doesn't mean we trend in the wrong direction or the other direction, but we typically close that gap. The bigger the gap gets, the easier to close it up. And that's a pretty decent sized gap right now. You know, you look at how far it's been up in the past. Here, let me get the. Oh, this is so annoying. There's a lot of things that just bug me about this platform. All right, we'll go to 30 week, and then we'll keep it on a simple. All right. So there's our PPO and how far up above, and you can see in the last 5 years, you know, that's about as high up as we've been. Here, let me switch this to 5.38 because that's where we were. So I'll edit this and go to 5.38 here. Okay, that's as high as we got, but you can see, like, you know, again, we got that high here and we had some weakness. That didn't change the trend, but closed the gap. We can see some here too, and this one actually did change the trend, but we're not expecting the same. You know, this was a really strong, you know, the dollar was really strong coming out of the credit downgrade, and, you know, and this big risk appetite. I mean, that was kind of a mini bear market, so to speak. And then some of these others you can see, for example, when we got here at the beginning of this significant move in the euro, multi-year move, we got really strong, just like right now. And then we went sideways for a while. We got light pink shading yellow line, and that sparked a big time run to the upside. So, you know, very well could be seeing something similar occur. You know, and I wouldn't, on anything like that, I wouldn't see us getting anywhere below this 114 mark. And again, if we pulled back in that scenario, you would see more of a pullback in the S&P 500. You'd get an intermediate line falling below 50 finally. And we'd just look for it to find some layers of support that it can come down to. And as we saw before, you know, that led to a real significant rise after that. And you would expect, you know, stocks rallied all the way up to right here to October 2007 is where stocks peaked. The euro kept going up with because commodities and inflation lag. But, you know, you can have a pretty decent rally coming off of that retracement here. All right, now let's take a look at how the sectors performed today. So let's come over here and we'll just look at today's move. Let me come here to August. All right, so you can see, again, kind of an anti-dollar trade, interestingly enough, even though the dollar was up. Industrials and transports were really taking off. Energy stocks really taking off. You know, again, they've got good reason to take off. You know, from a 1 year standpoint, they're still laggards. They still got a long ways to go. Industrials, financials too. You know, you wouldn't expect the utilities and real estate to take off, even though they're lagging here. But you would expect these cyclical areas to start to take off more and kind of catch up where these large cap tech names are already, you know, 44% return in a year. It's a pretty decent year, even with a one of the biggest pullbacks that we've ever seen in such a short amount of time. You still have a 44% return over the year, and you still have 20% plus returns, and the other two sectors that are QQQ related there. So you see some of these other sectors showing some strength. If you take a look at the 12 grid for them, of course we continue. I mean, we have dark green shading and green lines across the board, but industrials finally showing up here. Financials showing a cluster on a renewed dark green shading and green line. Kind of interesting pattern there. Energy breaking out. It's got dark green shading and a green line again, finally. So you've got some really good positive patterns here. Here is the chart for energy stocks. You can see how it's just kind of getting going. Look at that spike in the momentum line, and the near-term lines going up. The intermediate line finally crossing up above its market sentiment. There's your industrials kind of breaking out here to the upside, and of course your financials also starting this new bullish trend and starting it with a cluster, and that's a good sign. It's a reflection of expectations that yields will continue this little bullish move that they're starting. It's been so bearish that, as bullish as these moves have been, you can see they've kind of gone nowhere. But at least you've got a big bullish near-term peak here that we haven't had for a while, and we'll see how long that near-term line takes us, and how if we get the intermediate line to cross up above its market sentiment, something like this, that we might get more of a run than just what we got there up to pretty much 90 basis points before we started this decline that we've seen. You would expect, if we're going to be in a risk appetite mode, you would expect yields to rally, and we haven't seen that yet. But the more this does, the more broad, instead of being a large cap tech rally, it's going to be more of a broad rally. That will actually, you would expect large cap tech to go. They might not kill small caps like they have been doing, and they might actually lag small caps a little bit. It's if they lag a lot, that's when we're concerned about bear markets. But they can lag a little bit and still maintain strong long-term relative strength versus small caps. And I think that would be, a reflection of yields rising would be a reflection of more of a broader rally than what we've been seeing here in a small space. And you can also see that too from a global standpoint when you look at the 12 grid for the 12 largest economies. Again, dark green shading and green lines across the board, except for a few things that are catching up, right? China and Brazil trying to bounce and get back to there. But everything else, it very, very continues to be more of a broad rally than what we saw previously. And that's a good sign for the markets. All right, so for our trade idea of the day, I want to take a look at Tyson Foods. Tyson's been one of those companies that have struggled with COVID, one of the underperformers, one of the quote-unquote dead weight, so to speak. But unlike, companies like even the airlines for that matter, or especially like the cruise liners and hotel industries, this is considered a staple. This is part of our, this company is part of that food chain. And it got hit pretty hard with COVID cases at their plants. But you wonder how much those things there might be changing. We see, we've had a good earnings, a good response to earnings. We have a new intermediate trend starting here, intermediate posture. You can see, it's one of those situations where we're either going to take off from here, like at this point, and take off on a new trend, or we bounce back down. And we've seen past precedent is for us to kind of take off here with the intermediate line crossing up above the market sentiment on a weekly chart, mind you, and running over. You take a look at its 3 green arrow chart, and you can see very bullish pattern on the chart here, and the 8 and 17 have just barely crossed above the 30, so they've got room to go to trend for a while. In fact, if you take a look at the trend strength, we're just barely getting above the cloud, and the trend strength is starting a good bullish posture here. We had this happen before, and we'll see if it takes this time or not. The RSI did get above 60. The CCI got above 200. Again, happened before, but that time it didn't hold, and this time we'll see if it holds. On this regard, you can see the DMI this go around. You had on this go around, you had the the negative directional index was just barely crossing below 20 and then popped right back above, and the positive was just barely getting above 25. Well, now the positive is flirting with getting above 30, and the negative is well below 20. So much better opportunity from this indicator's perspective for a trend to develop here than what we saw previously. And you can see too, again over here, this is that June 8th period with all those dead weights. We're playing catch up. Well, again, if we can get through and really get going into this gap, this point of control can act as a center of gravity when you're inside the value area. But when you have a big gap of volume as well, that can act just as strongly in the other direction as a vacuum to suck you up into this gap and fill you up to the up and get you through to the other side, to this upside. So if that ends up being the case, if we are kind of potentially breaking out, then the trade that we looked at today was to sell. Excuse me here. Was to sell the 72.5 strike, buy the $70 strike with a half a normal position, with the idea that if it takes off to the upside, past up to 72.5 or beyond, and if you recall, the gap is all the way up to 81. This is where that volume is, all the way up here. That's where that old low point is. So if we can get up through 72.5 all the way up through 80 into that area, then for $500 at worst case, see, this has got a very good chance of getting out with even less than that. But at worst case scenario, losing $500 to try to make over a couple grand by October expiration, there's a good opportunity for something like that to happen. You can see so far in the app, so far today, since we put this trade on the Market Outlook Live, we've got a little bit of a move to the upside. So good sign for us. So that's our trade idea for the day. And again, kind of we'll see if while this plays catch up, if this can and be able to outperform for a little bit of time, but even if the catch up is done and now we just have a broader market rally that's more all encompassing, it might outperform large cap tech a little bit, but everybody starts to rally and it's not just 5 companies in the queues, then we would expect something like this to outperform into that volume gap and really get going to the upside. And remember, that volume gap's way up here. That's where the volume gap's right here, so it gets way up to 80. That's a lot of good potential there. All right, well, you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our Market Outlook forums on our website at marketscholars.com. Open up any new thread, reply to anybody else's thread, and let's keep this conversation going with any questions or comments you have about our video tonight. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon as well on YouTube as well as on Twitter and Facebook, and also comment. What did you get out of our videos? Again, thank you very much for watching. Have a great rest of your Monday night, everybody, and we'll see you all next time.